Good morning. My name's Nick Gale, and I'm Chairman of the Isle of Man Captive Association, or AIRMIC for short. I'm delighted to welcome you today to our inaugural Captive Insights webinar and hope that you find today's session interesting. Today is the culmination of a 6-month-long campaign to promote the island's long-established captive sector to professional advisors around the world and to help build awareness of the island's unique captive ecosystem. I'm pleased to say that that campaign has been a great success so far in terms of international reach and at a time when interest in captives is at an all-time high. I'm delighted to be joined today by 2 excellent guest speakers. Firstly, Tracey Skinner, who is the Group Insurance Director from BT Group PLC. Tracey is also the chairperson of the Association of Insurance and Risk Managers of Industry and Commerce, and has been recognised for her outstanding contribution to the captive sector as recently as 2017. Joining Tracey is Ben Waterton. Ben is the Executive Director for Professional and Financial Risks at Arthur J. Gallagher Insurance Brokers. Tracey, over to you.
Thank you, Nick. I'm delighted to have been invited to participate in today's Captive Insights webinar in conjunction with the Isle of Man Captive Association. You will hear today from a number of professionals involved in the captive insurance market. And the first of these I would like to introduce is Ben Waterman from Gallagher Insurance Brokers. Ben, over to you.
Hello, everybody. My name's Ben Waterton. I'm an Executive Director in Gallagher's Professional Financial Risks Division. I act for UK and international major professional services firms, and I've been asked today to talk about the professional indemnity market, specifically the background to where we are, how we find ourselves in such a challenging market, where we find ourselves today, what it actually means for those client services firms, and what we can expect for the rest of 2021 and the future. So, background to the market. Well, where we are is really a perfect storm. There's a whole bunch of quite complex dynamics going on in the market and have been for some time that have all collided to bring us to the position that we are in today. I'm going to focus on a couple of those, but obviously there's some much wider issues in play, which many of you, I'm sure, will be aware of. For those professional services firms that I act for, it's tough to hear, but the market does need to change, or did need to change. And I know that might sound a bit of an odd statement as a broker who are remunerated by clients who are driving the best deals, and of course that's exactly what we're out there doing. But the horrible reality is that we still need a functioning PI market, and without some of the changes going on at the moment, particularly around rating and coverage, that wasn't necessarily a given. And we only have to look at the D&O market to just see how challenging, or how that isn't functioning and behaving in a way that we would hope it would. So the last hard market was in 2001, and you know, I think everybody acknowledges that it was fairly short-lived and not necessarily a true hard market in the sense that we'd seen on a cyclical basis, you know, over the years. And that means that as an industry, we were going out to clients, and we have been delivering premium savings for 15, 16 years now. You know, going out talking about 5 or 10% reductions year on year on a compound basis. And of course, you don't need to be an actuary to understand that sooner or later, as an underwriter, you're going to end up underwater. And that's really the basics of it. It's no more complicated than that. It's been underpriced, the coverage has been too wide, and insurers have been have found themselves underwater. And sadly, they've been underwater for quite a significant time, and that underperformance was recognised by many of those underwriters, but the real driving force was the Decile 10 review at Lloyd's that compelled them to make some significant changes and corrections to their book to rectify that. And whilst all of this is going on, let's not forget that the claims environment that professional services firms face hasn't got any easier. those claims are only getting more expensive, whether that's in damages, costs, and actually, the quantum of claims as well has been going up. So all in all, a very difficult environment for underwriters. So let's talk about Decile 10 quickly and the performance review at Lloyd's. So in late 2017 is when we first became aware that Lloyd's were looking into the performance or underperforming classes within Lloyd's. And professional indemnity was right up there as one of the worst performing classes, along with marine cargo and hull and others. And what that meant was that Lloyd's wanted to identify those classes and then compel those underwriters to either rectify those classes and have a plan to rectify those classes and sign off those business plans, or actually they were going to compel the underwriters to stop writing that class. And so each of the underwriters had to come up with those business plans, and actually some of the underwriters chose to stop writing the plan. So in 2019, we had a significant number of underwriters, some really well-known names, deciding to exit the class, sorry, which made it difficult, because if you're a business that's buying big limits and you need that capacity, but also for us as brokers, by taking out underwriters from the market, that reduces the competition and the competitive tension that we can create on behalf of our clients to keep the pricing true. And examples of that would be Brit, Channel Novi, Aspen, Hamilton, Vibe, Acapella, China Re, and some of those have come back in, but it gives you a flavour of just how difficult it was in 19 and some of those difficult decisions those underwriters were making. And within those plans, we understand that our sense is that the average rating increase on a portfolio basis would be somewhere between 20 and 30% rating increase. Now, of course, that is the average. There were certain segments, certain industry classes that they wish to exit. There have always been problematic industries from a claims performance perspective in the professional indemnity space anyway. So I think there was a lot of focus on that. There was a lot of historic underpricing, and that was true of certain industry classes rather than others. And I would take for example the construction industry, where those rates had fallen greater than perhaps some of the other industries. And whilst we're sort of talking about those averages, it's not an exaggeration to say that we have seen examples where there have been either non-renewals or rating increases of, say, 200-300%. So some really dramatic corrective action that has been taken by those underwriters. Again, going to make the statement, but necessary action, corrective actions to keep them in the class. So the other thing that I would say, and you would imagine that many firms ask us this, is, well, okay, my risk is well performing. I haven't had any claims. I've been claim free for 10 years, or my claims performance has been good over a 10-year period. And that's true. And I think, there's definitely not a broad brush approach being taken by the underwriters in terms of the correction. It very much depends on a whole bunch of factors, in terms of sort of the individual performance, the type of work that you're undertaking. But sadly, for underwriters, they could not only penalise the bad performing risks. That wasn't going to re-engineer their portfolios. So what we see is that all firms have to rise with the tide. Otherwise, again, the re-engineering of those books just wouldn't be significant enough to sort of overcome the hurdles set in those business plans. And another thing that I would highlight as well is that it makes it very difficult for firms to show a rate reduction. And that is because, you know, weaved into the very fabric of these business plans for insurers is rate growth. And so even if there are external factors to generate competition, perhaps there's been a positive rating risk factor that's developed over the last 12 months, it's still very, very difficult for underwriters to sign off or get sign off for a rating reduction. So again, unless you are changing insurer, and of course we've already touched on the challenges of creating competitive tension because there's, you know, everybody's just so focused on their existing business, that becomes very difficult as well. So that's something to bear in mind. And then the final point I would say on this, and it's not a decile 10 issue, but something that underwriters have been very focused on, is that we understand that the reinsurance treaty in professional indemnity class has forced insurers to think very carefully about the line sizes that they're taking out or putting out to their clients. So that has been driving some of those behaviours where previously we would see, say, primary 10 million limits of indemnity. Those are being reduced quite significantly to stretches of 5s, 2s or 3s in some examples. And not only is that as a consequence of re-engineering their book through the decile 10, but also as a consequence of the retention through their new reinsurance treaties. The next thing I'd like to move on to and talk about is COVID. I intentionally haven't mentioned that because the corrective actions that I've just mentioned earlier were set in motion before COVID hit, and of course in early 2020 we had this additional issue to face. Now, for professional services firms, I think there's two issues that we need to be mindful of. Number one is direct COVID related claims incidents, and that comes from remote working, lack of supervision, peer review, etc. It is more difficult to do whilst you're remote working than it is in an office environment. And also, you know, think about the behaviours that you're driving within your teams, within your new starters or younger members of staff as well. So that is difficult on a remote basis. Will we see an increased incidence in claims? Yes, I think that's an inevitability. We will see COVID-related losses that wouldn't have occurred if you were office-based. I don't think they're going to be huge. I don't think there's going to be a landslide of claims, but we will see those. And the second is the indirect losses, as a consequence of COVID. So we need to keep an eye on what's happening in the macroeconomic environment, because of course when we enter into a recessionary environment, we know from past experience that there's an increased incidence in claims against professions and professional services firms. So, you know, think about sort of survey and valuations, think about conveyancing transactions for lawyers, just two examples of those. And we know that insurers have that on their radar, and from conversations we've had with those insurers, we know that they're making provision for that. And I would suggest that, you know, sort of 1 or 2% provision on top of the rating adjustments that they're already making as a consequence of the performance review. So where does that leave us now? Well, it's an interesting one because, as you can imagine, I have lots and lots of clients discussions, and some of those discussions are quite challenging, as you would imagine. But what I would say is, I think you could make an argument that professional indemnity still represents good value for some of these firms. And so, you know, using an example of say 1.5% of your fee income as your premium for, say, transferring 200 million of your risk exposure to insurers, I think I could, and many people could say or make an argument that that still represents great value. Notwithstanding, it might not feel like great value because 3-4 years ago, you might have been paying 0.6 or 0.7% for that same risk transfer. But, taken in the context of where we are in the market, how difficult it is, what the limits that you can still purchase, and we're still seeing programs of 400, 500 million placed for our clients. Then I think that actually there's an argument that says in some cases, even with these increases, it is still great value. And also, if you go back, say, 15, 20 years, they would benchmark really well against the sort of rates that they were paying, the comparable rates they were paying 15, 20 years ago. So in 2021, for the rest of 21, I would say that the average rate increases on those portfolios are going to be somewhere between 15 and 20%. Again, that's average. There are some real problem areas still out there. There's some, construction is still very, very difficult for many of those underwriters. Anything to do with insurance mediation as a consequence of the FCA COVID BI case, will be problems that will be problematic, and we'll have to wait and see what that actually means for those industries. But there are some positives there. We've seen the majority of the corrective action, the real harsh corrective action, taken already. So that should leave us with rate increases rather than the true re-engineering that we've seen over the last couple of years. That does lead to some interesting client discussions though, and very pertinent for the conference, which is clients exploring alternative risk transfer. And obviously that includes captives. And there's really three things that I would highlight there. Number one is limit. So really we're only seeing that on the primary level because for the majority of cases we see very good value excess layer placements still in the market, obviously subject to the individual risk profile. But on the primary basis, where that suddenly becomes a discussion point is when the premium becomes a 1 in 2 or a 1 in 3 event of the limit, and that's something that they want to explore. The second is on coverage. There are certain elements of coverage that just cannot be placed or are incredibly difficult to place in the market. So they're being carved out of those PI programs. We've talked a lot about price, but it is a true hard market in terms of the coverage restriction as well. We're seeing many programs flip from an any one claim basis to an aggregate basis, and some of those professions needing to get dispensation from their professional bodies as a consequence. Or something, in the construction sector, for example, taking, hard fire safety exclusions as well. So that's a discussion point in terms of, well, okay, what other alternative arrangements can I make if I can't get that cover in the traditional market? And then the third and the really interesting one for me is about retention. So during the soft market cycle, retentions didn't keep up with the growth of our clients or professional services firms. Those were artificially suppressed, and as part of this sort of re-engineering, there's been some focus on retention, and that's been quite painful for those businesses. And in some cases, depending on the type of claims or type of work, you're seeing each and every claimant excess rather than each and every claim excess. And we're also seeing in some cases the aggregate being stretched out further, or the excess aggregate, the aggregate position of the excess removed completely, which of course is problematic for partnerships and something that they don't like the certainty about. So that is something that we've had a lot of interest shown in terms of seeing whether there's an alternative solution to manage that self-insured retention, say in a captive. And then finally, I'll touch very quickly on the future. So, the hard market's here to stay. I can't pretend that it's not going to be here for the rest of 2021 or in 2022. I think it's set in. I'd like to think, and I'd expect the rating increases to reduce. So those figures that we've been talking about, it should be a slightly shallower rise in the future. We've got some senior movement of underwriters in the market, and we're just starting to see some of that happening. That's quite interesting because, of course, that's useful from a capacity perspective. We've got some fresh entrants coming in, but also that might help from a competitive tension perspective. And then the final thing I would say is, just like I said at the start of the slides, you don't need to be an actuary to understand that if you go out and deliver 5 or 10% savings for 15 years, it's going to be underwater for underwriters. Well, the reverse applies. You don't need to be an actuary to work out that if we've had some of the corrections and rating corrections that are going through, and the more prudent underwriting stances that are going through those books at the moment, that professional indemnity will turn into an attractive class again. And then, of course, that's when we would expect the next phase of the cycle to begin. So hopefully that's been of interest, and there's a few points for you to take away. And I'd like to hand back to Tracey. So thanks very much. Bye-bye.
Thanks, Ben, for that very insightful look at the current trends in the captive industry. In our next session, you'll hear from Isle of Man-based Chris Till and Ross Dennett, who will explain the benefits of having a long-term established captive in the Isle of Man.
Well, thanks very much. So we're going to spend about 15 minutes, Chris and I, just talking about a classic case study which involves the Standard Bank captive called SIL. So, Chris, thanks very much for joining us. If we could possibly start with the respective introductions, if you could give a summary of your position at the bank.
So I'm Chris Till. I'm the CEO of Standard Bank Isle of Man Limited on the Isle of Man. I'm also Ireland head, so responsible for all the other businesses that Standard Bank operates here, which includes the captive, and I'm a director on the board of the captive as well. Okay, great. Thanks, Chris. And I'm Ross Dennett, chairman of Thomas Miller Isle of Man. I've worked in insurance for the last 32 years, 22 of which have been in the captive sector. Chris, I think it's probably appropriate or a good idea if we could sort of start off with just talking a little bit about the Standard Bank Group, which is obviously the insured entity by the captive. If you could sort of summarise the group, give people an insight into the sort of scope of the organisation. Okay, well, Standard Bank's the biggest bank in Africa. It's in over 20 countries in sub-Saharan Africa, headquartered in South Africa. It's 56,000 employees, and it's quite a significant presence. So we have a presence outside Africa, although the concentration of the business is really African. Yeah, and certainly from my experience with the group, it's very well sort of structured and organised group, lots of very robust systems and controls and procedures, which is particularly relevant for the captive. So the bank's been in existence for 156 years, so and that's obviously developed over time, and it's quite a mature business, so with a mature footprint in South Africa, which has expanded over the African continent. So a lot of those controls and processes have been put in place over time. So it's a well-managed, well-run business. Yeah, excellent. Okay. So perhaps if I can sort of summarise a little bit about SIL, its journey, over the last 25 years. So it was established in the Isle of Man in 1995. It's obviously authorised by the Isle of Man Financial Services Authority, so very robust regulatory regime in the Isle of Man. It holds a Class 12 licence. And effectively it's licensed to insure all classes of business within the group. The group preference is to basically insure two primary classes of business, which is the professional indemnity and the crime, and then also more recently with the cyber market developing so significantly and the cyber risks developing so significantly, it started to write cyber risks. The strategy of SIL since its formation 25 years ago, and you would know this through your involvement, has been very much to retain risk within the captive, manage that risk through strong risk management processes through the bank, and ideally build up reserves within the captive and grow the balance sheet in the process. And there has been, through the duration, during the soft market cycles, there has been that desire to grow the balance sheet. in anticipation of the inevitable market turning, which we've seen in the last couple of years. And that has enabled the bank to take preemptive and proactive steps to increase the retentions quite significantly, and that's proved very beneficial.
Yeah, and I think the sort of key from our perspective is that we're a RAND-based organisation from a headquarters perspective, and the captive in the Isle of Man gives us a whole currency balance sheet, so it's a dollar-based balance sheet, so obviously our risks are in different currencies around the different territories that we operate in. And having that capital base external to South Africa helps from that perspective, but also managing the cyclical base of claims as well in terms of how insurance develops over time, what cover you can get in the reinsurance market, what the cost of that cover is. So having the captive to manage all that is almost like the ideal vehicle to, like you say, manage the risk within the business and make sure that there's no excess risk that we're actually covering, but also having that backup of the reinsurance as well to make sure that the whole of the risk is not based in the captive and its capital base.
Yeah, absolutely. And what we've also seen with significant risk retention within captives, and Standard Bank is a good example, is that what that tends to do is it drives the right sort of behaviour within the group. So it's generally accepted that if parts of the business know that they're accountable and it's going to ultimately hit their respective P&L, it inevitably drives the right sort of behaviour because they've effectively got skin in the game.
Well, exactly, and as long as you set those levels at the right time, at the right level, in terms of how the individual organisation or the individual bank or whatever is within the group has a certain amount of liability, and it's only above that liability that the captive comes in terms of the coverage, and obviously the reinsurance coverage above that as well, but also the dynamic of how the captive manages the claims, how also the reinsurance market reacts to the claims, drives the culture of that risk management within the business.
Yeah.
Because effectively, if there was too much from a claim perspective, then obviously premiums will reflect that, and the business have to manage their individual costs within their organisations to their expectations in terms of what they're prepared to pay for premiums.
Yeah, absolutely. And that actually brings us to some of the benefits of retaining risk within the captive. And the first of those is obviously the frictional costs involved within the captive are significantly lower than the conventional market. And we see that across most captives where the market has, inevitable inefficiencies and additional costs. You can sort of keep those costs quite low and quite tight within the captive. So that's one of the real advantages. And by retaining risk, by ideally having less claims than premiums going into the captive, you can grow your balance sheet and you can effectively push the market further and further away.
Yeah, and also that idea of the cyclical nature of claims, because it's never the same year. You never see the claims averaging out over a period of time. There's always peaks and troughs, and it's managing the capital within the captive, but also the coverage from a reinsurance perspective, because that's how they'll look at how they price that particular coverage as well. So making sure that there's a proper analysis of those claims and understanding what the claims history is and how that's managed within the business. But the captive is almost like the buffer to the reinsurance market as to how they perceive it as well.
Yeah.
But like you say, you can manage the premium that you charge to your own entity effectively from the captive based on the capital retention that you've got within the captive as well.
Yeah. One of the other big advantages that you've got a well-managed risk is that inevitably you're going to have claims. We've seen claims going through the captive. It's just the reality of a big organisation. But the payments of those claims are essentially you're paying your own claims, as opposed to paying the claims of another entity which may not have as robust risk management processes in place. So you essentially sort of reap what you sow.
Yeah, and you can drive that internally within an organisation, because obviously the captive is quite close to the insurance committee within the group as well, in terms of actually managing that risk and making sense of what is an unacceptable risk or an acceptable risk, and how we actually price that and what we're prepared to cover through the actual underlying nature of the policy itself, because there's some bits that are exempt from the policy, some bits which are included in the policy, and that's obviously built up over a period of time in terms of the coverage. But you have to clearly think about how you're actually going to manage that and what behaviours you're going to drive within the organisation through the behaviour of the captive. But that gives you that element of control within your overall group rather than having that externalised. Because if you basically bought the insurance externally, you'd actually have no management of that and no control over it.
Yeah.
And the captive definitely gives you that.
Yeah, and we've seen that particularly over the last couple of years. The reality is that we've seen a soft market for probably the last 20 years, and the last sort of tough market for insureds, for buyers and for brokers was probably immediately after 9/11. So it's a long time since the market's been this way, and it's a bit of a shock actually for buyers and for brokers in many cases, where the market is very much dictating the terms and dictating the policy coverage.
And you also get the individual reinsurers within your scheme as well, whether they actually like African risk or not, then they might take a different position on that, depending on other factors which are maybe external to Standard Bank. Whereas others, they have appetite for financial institutions, whether they're African or not. So you see that nature of reinsurers almost changing their risk appetite. Some people want to be on your program, some people don't. But like you say, it's been more challenging over the last few years in finding enough reinsurers to cover the whole program. But like you say, preempting the expectations of the market by taking more risk into the captive has certainly been a strategy that's proved very positive for our captive. Yeah,
it demonstrates to the market that the organisation's got skin in the game effectively.
Well, exactly.
Yeah. And also one of the challenges that the captive has faced, or the organisation has faced, is that a lot of the risk, as much as possible, is retained in the South African market, but the reality is that market is not adequate to retain all the risk, so a lot of that risk ends up insured into the captive and then reinsured into the London market. So there is an educational process involved in terms of the London market and its perception of African risk, for example, which involves delicate management.
Yeah, and there's also that aspect as well, is that as a South African-based entity, headquartered, do we want all our risk covered by South Africa rather than internationally? And therefore, from a captive's perspective, there's also that aspect of, where we want our coverage, and also, our measurement of the risk of the counterparties that we reinsure to as well, to make sure that, there's a good spread of those with, good capital bases and good credit ratings. So that's an element of risk that we have to look at from a captive perspective in terms of who we're prepared to reinsure through, because the reinsurer, if they don't pay at the end of the day, then what's the substance behind them to actually get the claim paid from that perspective, as opposed to then the bank not having the claim settled in accordance with the policy.
Yeah, absolutely. And then obviously with the development of cyber risks over the last couple of years, that market has taken off significantly. Initially, cyber cover was written at a relatively cheap price, but it's becoming noticeably more expensive in the last couple of years. I think the insurers that have written that risk are sort of realising the exposure that they've actually underwritten. So we've seen a significant increase in the pricing in recent months, and interesting that the bank took a proactive decision a couple of years ago to enter into that market and wrote a portion of cover in the captive and obviously reinsured.
Yeah, and for an organisation like Standard Bank, cyber risk is a significant risk for the business. So, writing that cover was something, like you say, we were proactive with. But it'd be interesting to see how that market matures over time in terms of the cost of actually buying that particular coverage. Because like you say, is that there was an opportune moment for early entrants, but then some of them may have got their fingers a little bit around it. And I think, I always go back to, remember somebody saying you'll never totally mitigate all your cyber risk. It's just about when you'll be maybe cyber attacked rather than if. So having that coverage in place is obviously a good thing, but I think over time it'll be interesting to see how that market develops.
Yeah, absolutely, yeah. And then probably just what would be quite useful is to talk about the current insurance market cycle and how that sort of ties into the last couple of years for the bank and for the captive and the journey that it's been through. So we had, as I mentioned previously, we had a sort of relatively soft market from 2001 through to 2018. And then the signs started developing where the market was sort of changing. It wasn't immediately hard, but it was definitely heading in that direction. There was, different views as to the extent to which it would harden. But I think probably the sort of final catalyst was the Decile 10 exercise, which happened in Lloyd's, where they basically sort of laid down the law and said that, individual syndicates need to hit their business plan, i.e. need to be profitable, otherwise they'll be shut down. And that really sort of, I think, sort of was the final straw that basically took it to what we see now, which is a particularly hard market, particularly in the financial lines areas, which is obviously right in the sweet spot with this company, or the professional indemnity and the crime.
Yeah, and I think certainly as a board as well, it's the thing that we've probably spent more time on than we ever spent in the past in terms of the renewal and the challenges around that. And, in terms of our broker, obviously working hard to get together a program, because, it's not just one insurer, there's a number of reinsurers, a number of different layers of the reinsurance as well. So it's quite a difficult thing to put together, but obviously we also want to put across the bank's point of view in terms of how we manage our risk, demonstrate that in terms of the renewal program, when we present to the reinsurance market as well, to make sure they fully understand that, not just looking at it from a distant perspective in terms of, it's African risk and therefore there's certain dynamics maybe that they don't like. So I think that's been the challenge, but obviously, you need to manage that challenge over a period of time, but also make sure that you almost have a strategy about how that develops. So understanding how, the mechanics of the market hardening even further might affect the captive, how we can manage that risk within the captive. So rather than thinking by year in terms of the renewal, thinking out a little bit further in terms of, what we would need to demonstrate both as a captive and a bank to the market, but also how the market might react to certain events, etc. And obviously, COVID's been, a significant, world event in the last, 18 months, 2 years.
Yeah.
So it'd be interesting to see how that develops and how that affects, because that might affect the reinsurance market, not necessarily for a crime and PI cover, but other claims that maybe, like I say, certain insurers have had to bear, where maybe it's affected their capital positions quite materially.
Yeah, absolutely. And also part of that process, part of that journey, obviously sort of, managing the expectations within the bank in terms of where the inevitable outcome, so where the retentions, will go to, because whilst the risk is retained in the captive, that's obviously when, the captive consolidates back into group, that's affecting, the business bottom line. And it's sort of creating that acceptance, that understanding within the bank that the retentions are going up quite significantly as a preemptive approach to the market.
Yeah, and that's why we keep very, very close to group in terms of making sure that they understand that on an ongoing basis. It's almost like no surprises, and how that's going to play out over time, and making sure that people understand it. Because prior to me being involved in the captive, I knew very, very little about how captive insurance knew. I knew it from how to bank captives, but not from how the mechanics of it. And I think it's a very complex subject. You obviously need expertise, but making sure that people at group understand what coverage we're providing and why we're providing it, and also the mechanics of how the captive work and its reserves and how you can actually take retention within the captive. But it's not a never-ending pot at the end of the day. And the last thing the group want to do will be to recapitalise the captive in some respects, because that almost defeats the object in some degree. So it's a balancing act of the whole thing, but making sure that the captive is managed properly on a day-to-day basis, but also it can take more retention and more risk in the captive if that's appropriate at any particular time.
Yeah, absolutely. And what was quite interesting through that process is that there was lots of discussion in the market about the extent to which pricing was increasing. So we were seeing sort of stories of organisations paying, increases up to sort of 400% on the professional indemnity and the D&O covers. And without going into the specific details, what was achieved through the retention increasing significantly within the captive, and managing the market perception of that increase in retention is sort of, mitigating the extent of those increased costs. There was inevitably going to be increased costs to the bank, but it was mitigated quite significantly, through effective utilisation of the captive.
Yeah, and that almost like, if you go with that story, then, the reinsurer is not going to have to take a hard line in terms of insisting on it if you don't want it. So going with that sort of openness in terms of the captive was prepared to take a higher retention was a positive move, and obviously the market in our particular case reacted well to that and obviously understood that. But like you say, it's a fine balancing act in terms of getting that right at one particular time, and you only know whether you're right or wrong depend on the claims that come out over that particular period of the policy as well.
Yeah.
And some of those claims may not, crystallise for a particular number of years, given the complexity of some of the types of claims that we see.
Yeah,
so, it's one of those things. You look back in 5 years' time, was it the right decision? Was it not the right decision? But you can only make those decisions at the time for the for the best motives for the captive and for the for the insurers as well. So.
Yeah, it's a really good point, because the exercise that we went through, in conjunction with the brokers, was basically to retrospectively apply the higher retentions to the historic claims experience. So, you're very much looking in the rearview mirror. You're basing it on your historic claims profile, which is probably the only sort of logical basis on which to calculate. The disadvantage is that, as you say, you don't know what's ahead of you. You don't know how the risks are evolving within the bank. So, you're very much reliant on your on the business, managing the risk in the knowledge that those retentions within the captive have increased quite significantly.
Yeah, and also you can stress test that to a certain degree as well, in terms of how that might play out over a period of time, and put various scenarios in as to what that actually would mean for the capital of the captive. And obviously we've got capital requirements from the regulator as well, and how we manage that, and it's one thing that we discuss on a regular basis in terms of the capital adequacy of the captive itself, because we as a board have direct responsibility for that. So making sure that we can manage that adequately and understand the risk that we're writing, and what would the impact of this level of claims, that level of claims, with the extra retention that the captive's taken.
Yeah, and what's also been, I think, particularly important with this captive, with those significant retentions, is the interaction with the group through the GIC committee, but also a very energised, dynamic and active, engaged, captive board, which is particularly important. The board is mature, it's well informed how it all operates, and that's from a manager's perspective is particularly useful. Having a very capable and competent board.
Yeah, and that's key, because the way that a captive is managed, obviously from a Thomas Miller perspective, you professionally manage the captive on a day-to-day basis, but we have a responsibility as a board, and in terms of the other boards that I sit on, I'm more probably actively involved in the day-to-day at a board level from the captive than I would be on any other boards, because a lot of the other executive responsibility would be delegated to governance committees, etc., and we don't necessarily have that within captive. But I think you're right in terms of having the right people on your board, having that level of engagement, that level of knowledge, and also different skills, different experience that they can provide input to that, and obviously experience that, of other organisations as well. And sometimes that's key, especially in your non-execs, is what they're seeing in other organisations and the market generally, rather than it just being solely looked at from this particular captive's point of view.
Yeah, so that, I think it's clearly evident that the last 25 years for SUL and for Standard Bank, it's been very beneficial having the captive, particularly relevant in what we're seeing at the moment with the market. So long may it continue, and hopefully those claims will be less than we anticipated and we modelled.
Yeah.
So thanks very much, Chris, for your time. Really appreciate your input.
Yeah, thanks for inviting me. It's been a pleasure.
Thank you.
Thank you very much, Chris and Ross, for that interesting conversation, which ties in nicely with the next part of the morning, which is myself and Richard Bray from Aon.
Good morning. I would like to welcome everyone to this Isle of Man Captives Insights event. This session will focus on current risk management trends and the increasing utilisation of captives in what is a period of market instability. My name is Richard Bray, and I work for Aon in the Isle of Man, and I'm also a member of the Isle of Man Captive Association Executive Committee. I've worked in captives for 12 years. Prior to that, I was a casualty underwriter in the United Kingdom. I am delighted to introduce Tracey Skinner, who is a Group Insurance Director for British Telecom PLC, and in her spare time is also the Chairman of AIRMIC. BT has had a captive on the Isle of Man for nearly 30 years. Well, I'm sure everyone will agree that you've probably heard enough from me for now. So I'd like to start this discussion by asking Tracey if she could set the scene for those joining us regarding why British Telecom established a captive and why the Isle of Man was chosen.
Richard, thank you for inviting me to this event. I wasn't at BT 30 years ago when the captive was set up, but I've been in and around the telco industry for about 25 years. And from my knowledge of what was happening at that time, I think the industry was expanding rapidly, changing rapidly, and I believe that the sort of open insurance market was slow to respond to the needs of telcos. And I think they were feeling that this whole way that insurance worked was just not suitable for them. The breadth of cover was just not suitable for their business. I mean, when you are asked questions like, can you please give me the postcode of every single one of your assets, and your assets are deep cables under the ground, how on earth do you conform with that request? So I think it was all about breadth of coverage, price and suitability, which really drove the telco risk manager to think about a captive as an alternative to some of their insurance solutions. And the Isle of Man has continued to serve us well in respect of the availability of skill and resource, and all of the other hosts of accountants and lawyers and everybody else that we need to support the captive are all very much available. The regulatory regime is robust, but suitable, effective and efficient. And I think all of those things together give us a very good package and continuing to use the Isle of Man for our captive.
Thank you, Tracey. What a concise explanation that was. So from what you said, there was an obvious need for the captive. However, it would be great for our viewers to understand how the risks within British Telecom have evolved over time and how the captive has helped to manage these risks.
Yes, so there has been, as I've said, a great deal of change and growth in this industry. And the risks have typically moved in a direction away from physical assets into the cloud and round into the cyber type issues, which are now very high on our agenda. We have found that we have the ability to have a very wide wording, which then, as we're attaching at a quite robust level for some of these covers, gives us a very good slice of cover, and then for looking for reinsurance or excess layers above that is a lot easier than it would be if we were looking ground up. However, we do need to be aware that our cyber risk and our professional liability risk do have the ability to impact at once, and therefore stop loss protection is something that we're constantly looking at in terms of what should that level be. Without a doubt, increasing retentions is the way you have to go in the market at the moment in order to even come close to meeting your budget. I think the beauty of a captive is not only can you use it at the bottom end, but you can use it, as we have, to kind of fill in some of the top layers as well. When you get things happening like the sort of tail wagging the dog in terms of some of the excess capacity in pricing. I think the biggest change that we've made, and it's been made very recently, is to use our captive for directors and officers liability, which is something, hand on heart, I would not have dreamt of, 5 years ago, but it was absolutely necessary, I think, for us to use the captive for some side B protection. Because the market reaction was just excessive pricing that we just couldn't afford. So I'm very pleased with the design of our current programme.
Thank you for that, Tracey. I think most of our viewers will have experienced recently the vagaries of the hard insurance market, and this was discussed in depth in the earlier market overview. With this in mind, can you describe the issues that you're currently facing due to the insurance market, and can you offer any insight into how you're utilising the captive to deal with this? I know you've already mentioned directors and officers, but are there any other lines of business that you're looking for the captive to provide solutions?
I think what's useful for us is, I've already shared with you, the types of new things that we're doing, but I think we shouldn't overlook the use of our captive for employee benefits, because this is a really good way to diversify in terms of the spread of the book. And we have a global employee benefit package, and we also have the captive supporting some of our very big UK employee benefits, and all of this, combined with the traditional material damage, business interruption liability, PI, and now D&O is all very, very useful for us.
Thank you. Tracey, in your role as chair of AIRMIC, are there any industry trends that you are noticing at the moment?
We are seeing a dramatic increase in the interest around captives. I don't know if you're aware, Richard, but AIRMIC has a number of what we call SIG, special industry groups, and these are formed around areas that are of interest to our members. We have had a captive SIG for many, many years, and I don't think I've ever seen the attendance at that SIG so large as I have in recent weeks. So there is a massive interest in captives, and I think there are some organisations that in a very soft market have probably thought they've left their captive, they've let their captive go, they think it's not such a good idea, and they're probably beginning to regret that decision a little bit. So there's others where captive's been dormant or less active, where they really are looking, as indeed we have, in doing as much as possible with their captive. So in your role as executive to the to the Captive Association, the Isle of Man, Richard, are you also seeing similar trends? Are you seeing people, is there more interest than ever?
Absolutely, Tracey. There's a definite uptick in inquiries due to the hardening insurance market. What is quite interesting is the urgency of these inquiries, with companies receiving indications of either reduced capacity or increasing premiums close to the renewal date. Now, fortunately, the industry has a very strong relationship with the regulator, which can help with these urgent inquiries. Obviously, of course, it would be perfect if we could have longer lead-in times. However, that's not always possible given the way the insurance market is happening at the moment. What's also interesting is, and I think we've already discussed this in respect of British Telecom, we are seeing increasing risk retention from captive owners. That's not necessarily on the existing lines of business, but can also be in respect of incubating new lines of risk into the captive. So if we take an example of cyber, 10 years ago, cyber was quite often incubated through captives because the breadth of cover wasn't as required in the insurance market. That's changed, and cyber liability and insurance has become the norm. But recently, we are seeing trends in captive owners looking at areas such as pandemic risk, which is obviously very topical at the moment, but also the environmental and climate risks. We're also seeing existing captives review the covers and operations from an ESG point of view. One example of this could be captive owners looking to invest their funds in what could be classed as ethical investments. And I think that will be something that will carry on over the next 3 to 5 years. Tracey, just following on from that, from an operational perspective, how do you find the captive management process? What does it involve for you, and how have you found the regulatory environment in the Isle of Man?
Richard, I have found it quite incredible in terms of some of the things that we have, we haven't stood still in terms of the changes we've made to our captive with regard to capital and, other changes. It's kind of fairly constant. And yet, it really is important to us that the regime in the Isle of Man is a robust one. We have, a heavy brand and reputational risk, from anything happening that, that shouldn't happen. And therefore, this is very important to us. So we have found, it is robust, as I said earlier, but it's important to us that it is robust. But at the same time, we've found it very efficient and very effective, and things move really quite smoothly in terms of, the requests that we make for change. And, let's face it, I think, one of the cabinet changes we made shortly after lockdown. So, the regulators weren't working in their normal environment. And, that seemed to me incredible that we got, a fairly fast response in those circumstances. So, it is all, working very well for us and continues to be robust, which is important.
Well, I think we've probably covered the main areas, and hopefully some of the discussions that we've had will have pricked the minds of the listening audience. May I take this opportunity to thank Tracey for her time today, and I will now hand over to our live panel. Please do not hesitate to take the opportunity to ask the panel any questions you may have.
I'm Service Director of Waterton, and Ross Dennett, also we have Ben online. Ben is the Indemnity Insurance Specialist at Gallagher. Looks like we've got a couple of questions coming in already. So to have a look. Yes. Here's one for Nick. What is the process for establishing in the Isle of Man? Can you take that one for us?
Sure, thanks, Tracey. Yeah, so the process probably involves three discrete phases. The first is probably the most important. That's developing the business plan for the captive. So that would usually involve understanding what portion of the insurance policy the captive will retain, how much it will reinsure. It's about coming up with financial projections that will form the basis for the regulator's review, which is probably the second part of the incorporation process. And then thirdly is the formation. So once the business plan has been approved by the regulator, there's the actual formation. That's the incorporation, setting up bank accounts, appointing directors, auditors, and then issuing policies. The overall process can take anywhere from a matter of weeks to a little longer, depending on the complexity of the captive, the insurance program, depending on the type of captive, whether that's a cell or a single parent captive. I know Rich mentioned earlier that sometimes we don't have a lot of time to set up a captive. So sometimes that's a very quick process. Mm-hmm. I think we'd all prefer a little bit more lead time usually in setting up. And I think we're starting to see a lot of captive owners start that conversation now, start to work through that feasibility study to develop that business plan. So, yeah, Rich?
Yeah, I think just to add to that, what we're finding is that with the market as it is, we are seeing some reactionary kind of situations where people are being forced into captive retentions. But actually, with the insurance market as it is, and probably for the next year or two, I think we'll probably see more long-term captives coming along as well.
Okay, thank you both. Got one for Ross here. How does a captive in the Isle of Man work with international tax requirements around economic substance? One that's very close to my own heart, as my boss is a taxman.
Well, actually, so there's a journey that we've sort of been on the last couple of years, working really closely with the Isle of Man tax team. This is all on the back of the OECD changes. The Isle of Man was one of
several countries that introduced legislation effective 31 December 18, essentially legislating the substance requirements on companies, not purely insurance companies, but across the sector. And the consensus at the time in that sort of industry workshop was that the insurance sector, and more specifically the captive sector, is in a good place. And the reason being that for many years, substance has been a real requirement in terms of line and management, board meetings, minuted meetings, physical meetings held in the Isle of Man, and then probably most relevant to that question, substance demonstrated by professional managers on the Isle of Man. So essentially people sitting in the Isle of Man, living in the Isle of Man, doing insurance functions, be it underwriting, claims, accounting, so real substance demonstrated. So through that process, close liaison with the Isle of Man tax team, we were pretty comfortable about the outcome of that exercise. Yes, the legislation is in place. Yes, there are substance requirements, but we felt through that process that the industry, specifically the captive industry, was in a good place.
Okay, that's great. One around new lines for you, Richard. So there has been a lot of talk about sheltering from some of the market hardening. And introducing new lines of insurance to maybe an existing traditional captive. Does this require regulatory approval in the Isle of Man?
As always with things like this, there's not a straightforward answer to that. It very much depends on the new line of business that the captive's retaining, and also the size of the business as well. So if it's a very small line on, say, a cyber line of business, then really there wouldn't be much regulatory interaction. However, if it's a larger risk with a significant retention that could potentially put more pressure on the capital of the business, then you would expect more regulatory interaction. And it also does depend on the class of license you have. So if you don't have the class of license for the business that you're proposing to write, you would need to attain that class of business. As the regulatory landscape changes over the coming 6 to 12 months, that issue should go away. Does that answer your question, Tracey?
Yeah, that's absolutely
Thank
fine.
you.
I think this one back to Ross. So we've got the PID and cyber. I mean, those are particular areas where the market can really hot at the moment, external market. Employee benefits, but are the other institutions trends starting to emerge?
Sorry, Tracey, was that question directed at me?
Yes, please.
I didn't hear. Would you mind just repeating it? I'm really sorry, but I didn't hear it.
Sure. Okay, so we've spoken already about PID and cyber trends for captive, because these are areas that are really hot. We've also talked about employee benefits, but are there any other approaches to stop them from emerging?
Yeah. So I think much like the situation back in sort of 2001, 2002, when we had the last hard market, what you saw then was, risks that were considered to be sort of exotic, like cyber, for example. Those sorts of risks were typically written in captives and as a sort of incubator type basis. The logic being to ultimately get the insurance market comfortable with the risk. So write the risk within the captive for a period of time, get some sort of understanding of what the claims experience is likely to be, and then potentially increase the levels of cover provided, and place it to a greater extent into the insurance market. So I think the sort of predominant discussions are around the financial lines, the professional indemnity, the D&O, which Ben's covered off. But I think, my personal view is that the market is going to be this way for some time. I can't see it sort of traditionally softening significantly in the next year or so. I think what's really happened is the market's taken a long, hard look at itself, at its pricing structure over the last 15, 20 years, And I can't see that pricing structure, changing significantly. Yes, capacity will come back in, and there'll be, potentially sort of refining of some of the rating, but I can't see that dropping off a cliff like it has in the past. So I think what we'll probably see is, as that sort of direction of travel continues, I think you will see emerging risks coming up on an ad hoc basis where, potentially there's an appetite and there's a viability to write those within the captive.
I just add to that, similar to what Ross saw. I think the whole insuring non-traditional lines in captives has been a phenomenon that's grown over the last 5-6 years. We've seen some of the non-traditional, like trade credit, supply chain, cyber as it was, come into captives before it kind of took hold in the conventional market space. I think, aligned to that, I think captive owners set up a captive initially for 1 or 2 lines of business that have real need, real issues. Yeah. After that, they tend to add additional lines of business, as they need them. What we've seen, I think, more recently is probably an expansion on the current lines of business. Yeah. I think Tracey mentioned earlier that, captives historically have focused on that primary retention, that primary layer. Where does that attach? How much does the captive retain? I think we're starting to see captives participate on that first excess, second excess, where traditionally captives haven't participated. They're now infilling to make capacity on excess layers. We're seeing that a lot where there's by par pricing from insurers, where the premium rates are a little higher than the lead reinsurers. So maybe not a new lines of business, but a different use for captives that we haven't seen in the past.
Yeah, absolutely. I would agree with that. And I think what's happening now is that captive owners are becoming more tactical with the capacity that they have. So, for instance, with property, there is still rate increases, especially in risks that have got, say, US Nat Cat exposure or things like that. And people are having to actually use some of the capacity in the captive to infill some of the risk there, rather than potentially using it for other risks. So we're certainly seeing that at the moment.
Yeah, I mean, I certainly feel as a captive user that we are in a situation where we're in a static place at the moment. I think, we are very much on a journey, and there's still more to come. I certainly suspect that. Ben, I would like to bring you into the conversation. Hello. Disallowed tenant Lloyd's was obviously a key correction point for the insurance market globally. Is the panel aware of any other similar reviews or interventions in the pipeline internationally that may have a similar impact in terms of rate? Is that one you're happy to answer?
I can do. I mean, I would take it in terms of the wider the wider regulatory piece. I think we know where we are on those, that the regulation in terms of re-engineering the book. What we are increasingly seeing, though, is the various regulatory bodies for industry types. So, RIBA, RICS, obviously the ICA and ACCA in the accounting world as well, have views on what is going on in the market at the moment and some of those coverage restrictions, and actually understandably quite concerned as well, because as we've discussed, a lot of that coverage is being taken out and a lot of that is quite important coverage. I could see that driving some of those behaviours certainly over the next 12 to 24 months.
Okay, thanks, Ben. So sort of four of you, I don't know who'd like to sort of go first cut on this one, but one very much of interest to me as well, a question just come in. What are the current trends to manage liquidity within captives?
I'll try that. It's I think one of the beauties of thanks, Tracey. I think one of the beauties of a captive, one of the potential benefits is being able to manage the timing of claims to a degree. That we're insuring related parties in most instances. We're not seeing a rush to very liquid assets. Captives historically have been quite risk averse, so they've invested cash, fixed deposits, primarily into company loans, which can be called upon quite quickly. We don't tend to see much investment in longer term investments like bonds, equities. So I think liquidity is probably already baked in to the system. There is that ability, I think, also to manage timing. You know, I think one of the other challenges is the availability of options. So Nick's absolutely right. You know, there is a lot of money put into money market deposits with the different banks and those institutions. Is obviously, you know, in recent years, the number of options available has sort of been declining. So it's a challenge making sure you sort of spread your investments across the various banks, and at the same time, you've got to be very conscious of the counterparty exposures related to those institutions. So, you know, as a captive, you want to make sure you've got that diversity. But ultimately, you know, captive is there to pay claims. So, you know, you never want to be in a situation where you're called upon by a group to pay a big claim, and for whatever reason, you're not in a position to pay that claim, because speed of payment is obviously a key sort of differentiating factor.
If I could just add to that, one example I have is a captive that's actually is actually buying bonds because it's got a very predictable and long tail claims experience. So it's basically matching its payment profile to the bond purchase profile and maturity profile. Other than that, as I would say, you know, money market funds are probably they're fairly typical. Banks and money market funds are fairly typical classes at the moment.
Okay, thanks, Richard. One for you, Ross. Insurance has been undergoing enormous regulatory changes with the intro of Solvency II and equivalents. How has that affected the Isle of Man captives? And is the regulatory landscape now settled for Isle of Man captive insurance companies going forward?
Thanks, Tracey. I think we've been on a journey, the Isle of Man's been on a journey for probably the last 7 or 8 years. That's essentially when it started, when the Isle of Man signed up to effectively be compliant with Insurance Core Principles, which is the global standard. So that journey has been, basically industry's been engaged in that process very closely with the regulator. I think the regulator has gone about that process very sort of diligently and methodically. There's been a few points along the way where, you know, industries felt that potentially the risk appetite had gone a little bit too far towards Solvency II, and obviously with the Isle of Man not being part of the EU, there's no sort of compelling reason to go full-blown Solvency II, particularly with the captive model, which is essentially group companies. So we've had very healthy dialogue with the regulator, and I think we've got to a point now when the legislation comes into effect at the end of this year that, you know, it's fit for purpose, it's appropriate and it's relevant. And I think, you know, it's also relevant to point out that from and you would know this, Tracey, from an insurance buyer's perspective, as a captive owner, you know, you want to be in a position where you've got strong and robust regulation, because that provides you, you know, as the owner with a level of comfort. So it's a very fine balance. I think the Isle of Man has sort of navigated its way, working closely with industry, navigated its way through this journey. And I think we're sort of about to reach the end of that journey.
Yeah, I think it's just worth, you know, adding that. I think the result, which I've come in halfway through that 10-year process, is where we're going to land is almost having 2 separate frameworks, one for captives, which is much more appropriate to a captive, and one that's more equivalent to Solvency II for commercial insurers. And I think that's the right outcome. That's where, like Bermuda got to. I think we'll be the second domicile in the world to have that distinction between captives and commercial insurers ingrained in regulations. So it's completely clear to everyone which side, which framework applies. And I think the captive by definition has also broadened out beyond just that related party. So there are instances where it's appropriate to have a lower regulatory framework for insureds that are fronted by a commercial insurer. That seems to be appropriate where there's informed consent in place. Now, those new regulations encompass that whole a gambit of lower regulatory needs.
Yeah, absolutely. I'd 100% agree with everyone there. I think the key output will be that the regulations are fit for purpose. I think where we've started and where we've got to, we've now landed hopefully on a set of regulations that are straightforward, sensible, easy to use, but also provide the regulatory constraint, I suppose you'd say. So yeah, I think we're all, as a panel, comfortable with the direction of the Isle of Man.
Yeah, sure. Okay. One really for you, Ben, is I know that we've already kind of acknowledged during this session that in terms of the open market, we feel the current pricing is probably, where we're going to be for some time. But if things do soften in those market conditions, is there actually a benefit for establishing a captive in the short term, or would we be better off just weathering the storm?
I guess a bit of a cop-out answer, but it is dependent on the individual risk profile, of course. I think that as everybody has said, the market is going to be very, very challenging for a few more years. We've talked about using captive as self-insured retention purposes for replacing, perhaps elements of primary limits, co-insurance, or indeed sections of cover that have been stripped out. I see a place for that over the next 5 years. And so to answer your question, in certain circumstances, yes. And of course, as we know, the way that you can engage and the risk transfer that you can use it for is dynamic, and you're not set just on what you set it up for today, because of course, the market will change. And I said that, it is going to get easier. The trouble is we just don't know how much easier or when that comes. Okay,
thanks, Ben. Nick, one for you. I've actually asked you this twice in your career at Marsh. Is there a limit on, for example, in terms of
well, the same answer, Tracey, as what I gave last time. Well, there seems to be some wisdom around this, is £1 million the right figure for a premium? Is it less than that? I think for a standalone captive, a wholly owned subsidiary, we tend to say that if your insurance premium is in the region of £1 million, it's worth considering a captive, or in excess of £1 million. I think the threshold for a protected cell is much lower. We've got protected cell customers that premiums are less than £500,000, and it makes sense for them. So there isn't really an absolute, but there are some general rules of thumb. And I think that £1 million of premium on a single line of business for a standalone captive probably is as good a rule of thumb as any. A protected cell, you might half that. But there are instances where insurance is mission critical to insureds, where at any cost they must have insurance to operate, whether they're regulated or their customers require insurance. And that captive premium might be much less than those figures. But the benefit is they need the insurance to operate. So there is, I know I've kind of given like an answer and then discredited it, but it's a tricky one to answer. But those are good, I would say, rules of thumb. I don't know if you guys see it.
I think the only thing to add to that is probably a more specific ratio would be your loss ratio. So if you've got a lower premium, but you've got consistently loss ratio of like 70%, then it's going to be a viable mechanism. You obviously want to be able to pay your operational costs for managing and running the captive. But if you had a lower premium than the £1 million, but if you've got a sort of relatively low claims experience, then it's probably going to be something that's pretty viable.
Yeah, I'd agree with that. And the loss ratio is very important because at the moment in the hard market, you're not typically getting the benefit of your own internal risk management. So if your risk management function performs better, and therefore your loss ratio is a lot better than typically the market your competitors are, then potentially the captive may work for you because of your improved risk management.
That's a good thing to bear in mind. With the rates increasing, the loss rate, historic loss ratios might improve as a result.
Absolutely.
Yeah, indeed. Yeah. Okay, thanks. Just staying with you, Richard, one that sort of features at our quarterly financial meetings. How do you manage any foreign exchange exposure within the captive?
That's a good question. So I've got one example at the moment, actually, of a very large claim in a currency that isn't the typical currency of the captive. So we're actually using hedging to hopefully mitigate some of the foreign exchange exposure that we have within that. It is always a risk within captives, especially when premiums are set in multi-currency and then claims are settled in multi-currency. However, hedging can be one thing, and either that or just managing the exposure on a day-to-day basis. I don't know, Nick.
Yeah, I was going to say asset liability matching tends to be what we see, where you hold the premium in the local currency to pay the claims in the local currency. It's never perfect.
Nope.
But that's, I guess, is the first tool that you'd use to hedge that risk. That's.
Okay. Well, thank you. That's all for today. We will follow up with answering any questions that we haven't so far. I'd like to thank all who attended and thank you to our participants. I really hope you found it insightful, and if you'd like to find out more on the captive insurance industry in the Isle of Man, you can visit www.captive.im. Thank you very much.
Thank you, Tracey.
Thanks, Tracey.
Thank you.